All right. Well, welcome you guys to our YIS Global Online meeting today. Today we're going to be going over Unit 2, Lesson 3, which is applying the PE ratio. Today I have Neha, who is our Midwest Advisory Board Vice President of our Student Advisory Board. And she's going to be in your instructor today, and she's actually in Arizona. So welcome, Neha. And without further ado, I'll let you take it away.
Hi, thank you for the introduction, Christine. I'll get started with the presentation. So I'll share my screen. Okay, can you all see my screen?
Yes.
Okay, cool. So as Christine mentioned, today we're going to be talking about the PE ratio. Oh, looks like there's a little bit of a lag. Sorry about that.
It's okay.
So, but I'll be going into how to calculate the PE ratio, what it means, and what it is, like how you can use it. So I'm not sure why this is happening. Oh, okay, here we go. But so while this is waiting, I guess we can start with the idea of the week. So every week we start off with something that's relevant to the current economy. So something that I noticed was coming up in the news recently is a recent resurgence in COVID cases. And I think some European countries like Germany and France are actually going back to lockdown and they're shutting down their economies again. So it's something that's pretty interesting to think about, especially considering that European countries are doing this. It's interesting to see how this might reflect on America. So does anyone have any ideas about how this might affect the American economy?
I definitely think that Americans who invest in international stocks may have a little bit of trouble there, because I know I'm invested in Chinese stocks, and if there is a second surge of coronavirus, that might affect those general companies.
Yeah, that's a great point. Does anyone else have any ideas? Okay, I can share some of my own. So sorry about all the notifications in the background, but I definitely agree. And I personally don't think we'll go back to lockdown, but I do think that this might show some vulnerabilities in our current handling of the coronavirus. And I think that it's likely that we'll have to kind of go back because the recent administration has been trying to open everything up. And I think that this might cause some backlash, and especially with the resurgence in COVID cases, we're probably going to have to pull back a little and try to slow down economic growth a little bit. I guess I'll just present from here because the full screen isn't working, but I'll get started with the lesson for now. So today I'm going to be talking about how to apply the PE ratio. So an overview of today's lesson is that you guys are going to learn and apply knowledge of the PE ratio. So for those of you who don't know, PE ratio stands for price to earnings, and it's basically the price of the stock divided by the earnings per share. And we're going to talk a little bit more about that later. So, and then we're going to wrap up the lesson with a learning activity that's talking about how you can use the skills that we learned in today's lesson to decide what companies you want to invest in the long term. So some objectives for this lesson are that you should be able to understand and calculate PE ratios, and you should be able to understand a company's value by applying your knowledge of the PE ratio along with market cap and value. So now let's get started. So for this lesson, you guys are going to have to use Yahoo Finance. So it would be great if you guys could all go to finance.yahoo.com and find some data for 3 companies of your choosing. So the data is going to be earnings per share, the current stock price, and the PE ratio. So you guys can pick which 3 companies you want to choose. If you don't have any ideas, then I can't really see the chat right now, but I guess some sample 3 companies could be like Apple, Amazon, and Microsoft. Those are some of the biggest companies, but you guys can pick whatever companies you want. And just give me a thumbs up when you have your data. Cool, I see Eliana's done. Okay, so Eliana, do you want to unmute and share the different values that you got?
Sure. Okay, so here, let me find it. I'm just kind of figuring it out a little bit. So Gilead Sciences is the stock. So stock ticker GILD. And price per share, I think that was one of them. Yeah, earnings per share is, I'm sorry, I'm trying to find that here. Let me start off with the price. Okay, so the price is $58.72. And I'm assuming PE ratio doesn't have a great deal to do with down to the exact cents with a company that is not like $10. I'm sorry, let me try to find that information. I'll get back to you in a second.
So Yahoo Finance should have, there's like an interface that shows up as soon as you enter a ticker symbol. So I think you mentioned it was GILD. So if you just type that in, on the first page, it should show the earnings per share. It might be abbreviated as EPS. That might be why you can't find it. So you should find that as EPS. And then below that, or it might be above that, you'll see PE ratio. So both of those values should be given to you on the website.
Okay, so I see that the PE ratio with this is not given, but I think we can calculate that. But the earnings per share is down 20 cents.
Could you say that again?
The earnings per share is down 20 cents.
Oh, okay. So here I can, Christine, is it okay if I go on Yahoo Finance? Okay, so I'll just go pick a random company and we can see the stuff. So I think your settings might be showing the change, but in order to calculate the PE ratio, you'll have to see the actual value. So, which is fine. We can just I can show you guys. So I'll just do Apple. That's probably like the most common company. It's the biggest company. So here, this is what will come up. And they give you a lot of different values, but for now, we're just going to be looking at the price. So here it shows that it's $111.20. You have your PE ratio, which is 33.74. And then you have the EPS, which is earnings per share, and that's 3.30. And in case you guys don't know, this TTM, that stands for trailing 12 months. So in the last 12 months, that's what the data is. So can you guys see any connection between these three numbers? Like you have 111, 33, and 3. So do you guys, I don't know if this question is kind of worded badly, but do you see any connection? Yeah, Eliana, do you have an idea?
Yeah, I have a pretty good idea. So you just multiply the earning per share times the stock price and then divide by 10.
So you're pretty close. So you take the price and you actually divide by the earnings per share. So you would take 111.2 and divide by 3.3. And I think I have a calculator with me. Let me see what that comes out to. So if you take 111.2 divide by 3.3, that comes out to 33.69, which is pretty close to 33.74, but you get the general idea. So you take the price and you divide by the EPS. So that was, yeah, that's the next slide. Try to find the relationship. And it should show that current stock price divided by earnings per share gives you the PE ratio. So now we're going to go on to handout 2.3. I do have it open. Should I just screen share?
Yeah, that would be great.
Okay, so this is handout 2.4. Okay, so here's handout 2.3. So as we said before, one way to determine the value of a company is the PE ratio. And this indicates how many years you have to wait at the current earnings rate of a company to get all your money back. So this is a new idea. I haven't really talked about this yet, but let's say that you have a PE ratio of 25. Then that means that given the current earnings of the company, you'll have to wait 25 years to get all of your money back. So we just talked about this. The price to earnings ratio can be calculated by taking the market value per share, which is the stock price, and dividing by the earnings per share. So now they go into an example. So let's say you have a company whose current price is $43 and the earnings over the last 12 months. So this is basically saying trailing 12 months earnings per share. That's $1.95. So in order to calculate the PE ratio, I probably should have covered this up, but okay. If I hadn't shown that, it would be 43 divided by 195, which is what they give you, which is 22.05. That would be your PE ratio. And as we mentioned above, this means that it'll take you 22 years if you invest in the company to earn back the price of the stock. And another way to look at what the meaning of the PE ratio is that you can think that investors are willing to pay 22.05 for every dollar of earnings that the company has. So you can think of the PE ratio as kind of like a relative value of the stock. So if you have a high PE ratio, that suggests that investors are predicting that there's going to be a higher growth of the stock, which is why they would be willing to pay a higher price for that stock. So even though if you have a higher PE ratio, that means that you either have a high price or a low earnings per share. So if you have a high PE ratio, that means that investors are still willing to buy stocks of a company, even though it might have a high price or has low earnings, because they think that there's going to be a lot of growth in the future. So a high PE ratio can suggest one of two things. It can suggest that investors are expecting higher growth, but it can also suggest that a stock is overvalued. So when you're looking at a PE ratio, you really want to look at how a company's PE ratio compares to other stocks in that company's industry. So if you can see that your company has around the same PE ratio as your industry's average, that's a good thing, because that means that it has not such a high PE ratio that it's overvalued, but it's still on par with the general growth trends. And this is compared to a lower PE ratio, which can indicate that a company is either undervalued or that its profits are expected to decline. So some people may say that you want to just find the lowest PE ratio possible because that means that a company is undervalued. But it can, just like how a high PE ratio can either mean it's overvalued or it's going to have growth, a low PE ratio can either mean it's undervalued or the profits are expected to decline. So you really just want to try to find a PE ratio that's an average compared to your company's industry. So does anyone have any questions about that, by the way? That's kind of the bulk of this lesson. That's the major content. Okay, so if not, I'll keep going with this exercise. So it says use the chart on the next page. I can show you that after reading this part, but we're going to be answering the following questions. So here's the PE ratio chart, and this kind of shows in a graphical form what I was talking about above. So if you have a super low PE ratio, and by the way, ROE means return on equity. So that's basically just your returns for investing in a stock. So if you have a super low PE ratio, then that can mean that it's either a low quality stock or it's low growth, or it can mean that it's undervalued. And same as you move along this spectrum, as you move towards a higher PE ratio, you can have a slightly higher growth, but it's still low growth. And this is around 10 to 12% in terms of the return that you'll be expecting. And around 15, this is an average company. So you can think of 10 to 20 as around average, 15 is exactly average. And this means you're going to have around a 15% expected return on equity. And now moving towards 20, having a PE ratio that's over 20 can indicate a strong company, so you'll have higher return on equity. But like I mentioned before, it can also indicate that the company is overvalued. So you have to kind of look at a stock overall and try to get a bigger picture to see what the PE ratio is really telling you, and if it's telling you that it's a strong company or if it's a little overvalued. So now if you're above 25, then that can mean that it's super high growth, or it's high quality, or it can mean that it's overvalued. And you can expect to have returns of over 20%. So some important things to keep in mind: the PE ratio can vary depending on what industry you have. So for example, the tech industry is, I guess it's known for having super high PE ratios. So a lot of tech companies have, like, they're expected to grow a lot in the future, which is why they have these high PE ratios, because like it says here, these are companies that are expected to grow really rapidly in the future. So in general, here are just a few key takeaways. The average PE ratio for the market over the past decade is 15, which is why this 15 line is the average. And an average company should be worth about the price should be 15 times greater than the earnings per share. So if you have a really great company, so really high returns, that's going to have a higher PE ratio, as mentioned here. And bad companies who have either unpredictable earnings and low returns, or they're a little undervalued, they can trade at below 10 times. So their PE ratio is going to be on this lower end of the spectrum. And a company should trade at about the PE ratio as its earnings are expected to grow in the future. So what this means is that the PE ratio indicates what investors expect out of the company based on how its earnings are predicted to grow in the future. So if a company is growing profits at 30% per year, then it's going to have a PE ratio of about 30. And further, if a company is growing at about 15% per year, it's probably going to trade at around 15 times that's its PE ratio. So a company that's not growing at all may trade at 5 to 10 for its PE ratio, and that, as seen here, that may indicate low growth. So now that we've gone over the chart, we can go on to these questions. So the first question is, Company A has a current stock price of $62. The earnings over the last 12 months were $2.95 per share. What is the PE ratio of Company A? So does anyone have any ideas about how to calculate this? Okay, if not, I can go through this first question, and then maybe for the next few questions we can try. But since they tell you the stock price is $62 and the earnings per share they give you is $2.95. So based on this formula up here, in order to calculate the PE ratio, you're going to take the stock price. Let me plug it in a calculator. You're going to take the stock price of $62 and divide by $2.95. And that's going to come out to around 21. So your PE ratio would be 21. Does that make sense to everybody? You guys can just unmute yourselves if you have any questions. Good? Okay, cool. So now we can move on to problem 2. So this one says Company B has a current stock price of $22. And now the earnings per share are now $1.95. So this one's asking the same thing. What is the PE ratio? So based on what we just did, does anyone want to try this one? I can't really see the chat. I don't know if anyone's saying anything there, but you guys can feel free to unmute if you have any ideas. I guess I can keep going. So it would be 22 divided by 195, and that's going to come out to around 11.3. So the PE ratio of Company B would be around 11.3. So now, using the chart that we just went over, explain which company is a better investment based on this PE ratio. So just to remind you guys, the Company A's PE ratio was 21, and for Company B, it was 11. So which one do you guys think would be a better investment? I can give you guys a hint. So a higher PE ratio will indicate higher expected growth. So you want to go for the one with the higher PE ratio, which would be company A. So based on the PE ratio, you would want to invest in company A, but obviously this is a pretty big oversimplification. When you're investing, you want to look at more than just the PE ratio, but in this scenario, company A would be a better investment. So now on to the fourth question. Do you think that a low PE ratio is always a reason not to invest in a company? If anyone has any ideas, they can feel free to unmute, and if not, I can just go through this question. So a low PE ratio should not be like an instant deter from a company because, as I said before, it can just indicate that a company is undervalued. So what this means basically is that investors are predicting that its growth will be low, when in reality, it may be a good company, which means that you'll be buying it at like a bargain price. So you can imagine something in the clearance section. That's basically something that has a low PE ratio. So this may actually be a good investment if it's a company that's undervalued. So a low PE ratio should not always be a reason that you just causes you to not invest in a company. So I think that's it for handout 2.3. Now we're going to get going with the lesson. So as you can see, this is just something that you might see if you look up like a stock price. So going back to Yahoo Finance, let's see if it loads. So that's what this diagram here is showing. That's basically what this stock is showing. So Apple is relatively stable, but something a little more volatile might have a graph that looks like this. So the true value of a business doesn't actually change very much. So the reason for all the fluctuations in the price are something called Mr. Market. So the PE ratio is a good starting point to determine the value of a company. So as we said here, the true value doesn't actually change. So the PE ratio can help you determine what that true value is. So something important to remember is that the two most important things that determine the value of a company are how much the profits are going to grow and how long that profit level is sustainable. So this basically means, like, number one is the growth potential. So how rapidly do you think its business or revenue is going to increase over time? And will it be able to sustain that high level of growth? So this slide is a little bit outdated. So I think this was made in 2016. So at that time, the three most valuable companies in the world were Apple, Google, and Exxon. I think now it's like, it fluctuates between Apple, Google, Amazon, and Microsoft, but those four are basically the top four companies. But Apple and Google have stayed at the top. So now onto a new activity. You guys are going to invest 10,000 in one of these companies. So now we're going to do the next handout, and this is 2.4. So as we said before, in 2016, the three most valuable companies were Google, Apple, and ExxonMobil. So your success as a potential investor is dependent on your ability to predict how a company's value is going to change over time. So like I said, these numbers are a little bit outdated. Like Apple is now over $1 trillion. So this has changed, but you should get the idea. Basically, these are the valuations. So using the chart on the Prezi, so that would be this one right here. So this shows you the stock price changes over time. And using the chart below. So this is showing you some of the financials, and you can also use internet resources. You guys are going to have 10 minutes. Christine, I don't know if you want to shorten that a little bit, but you can consider the following questions and decide which company you want to invest $10,000 in.
Yeah, we'll probably not take the full 10 minutes.
Yeah. So how about you guys, we can start off with like 2 minutes. If you guys think you need some more time, then we can lengthen that a little bit. But these are some, I can just talk a little bit about these financials while you guys can do some research if you want. And I think last lesson we talked about the market capitalization. So this is the price of the company multiplied with the total number of shares outstanding. So the market capitalization is basically the total value of a company. So when you look at the price, that's the price for one share in a company. But if you multiply that by all the shares, then you're going to get the total value of the company. So that's basically what this metric means. And these are some, I guess, metrics that you can use to find the profit. So the sales are going to be your revenue. And here it's 65.8, and this is going to be, I think, in millions of dollars. So it's not just $65.8, but it would be $65.8 million. And the costs are going to be, like as implied, the cost of production, things like that. And if you guys don't know, parentheses means that you subtract. So the formula for profit is revenue minus costs. So it's going to be the $65.8 million divided by $51.9 million, and that's going to end up around 14. So that's how you calculate this profit here. And the same thing applies for Apple and ExxonMobil. And your profit margin is going to be your profit, and I think it's like basically how much of a percentage of your costs that your profit is. So if you did 14, let me calculate it right now. So if you took 14 and you divided it by these numbers, then you would get a certain percentage, and that would be this value. So the next few metrics are average sales growth and average profit growth. So this is kind of related to the PE ratio and like what the PE ratio is expected to predict. So as we said before, a high PE ratio means that you have high expected growth over time. So here, this high value is indicating that you're going to expect high growth over time, which is why the PE ratio is pretty high. Compared to something like this, where like an ExxonMobil, the PE ratio is a lot lower than Google, and consistently, these numbers are lower too. So these metrics are pretty related to each other, because a high growth is going to mean that you'll have high return on equity and you'll have a high PE ratio. So I think that was around those few minutes, I think. So does anyone have any ideas about, let's start with number one. What company do you think will have the highest revenues 10 years from now? Does anyone have any ideas about that? So I can get us started. So you're going to expect high revenues if you currently have a high rate of growth. So we can look at the revenues right now. So right now you have a sales of 65.8 million for Google, 182.3 for Apple, and 364.8 for ExxonMobil. So it looks like ExxonMobil currently has the highest revenue out of these three companies. But if you look at their average sales growth, you can see that Exxon is lagging a lot behind these other two companies. So I would say that probably either Google or Apple are going to have the highest revenues 10 years from now. And if you look, Apple currently has higher revenue. So Apple is probably going to have the highest revenues 10 years from now. So now we can look at the profits. So currently profits are at 14 million for Google, 39.5 million for Apple, and 32.5 million for ExxonMobil. So currently Apple has the highest profits, and it looks like it also has the highest 10-year average profit growth. So based on current trends, Apple is probably also going to have the highest profits 10 years from now. So as of now, Apple is looking like a pretty good investment because it's expected to have the highest revenues and highest profits 10 years from now. So now number three is something a little different. This is saying, what company has the strongest competitive advantage or economic moat that a competitor can't replicate? So this is basically asking, which of these companies has the most unique product? So if you guys, you guys can unmute if you have any ideas. If you don't, that's okay too. I can just talk about it. Okay, so I'll keep going. So based on these products, so Google, as you guys probably all know, Google is a software company. Apple makes both actual products and software, and ExxonMobil is an energy company. So I would say that the strongest competitive advantage, it would be kind of hard to determine because both Google and Apple have really prominent competitors, but I would say that ExxonMobil probably has the most competitors because there are a lot of oil companies. So I would say either Google or Apple has the strongest competitive advantage. Now, number 4, given that we don't know what the world situation will be in 10 years, we may be in an economic boom or we may be in an economic bust. Which company can you be the most confident that will maintain profits in any economic state? So in number 2, we talked about how Apple is probably going to have the highest profits 10 years from now. So using that reasoning, we can probably predict that it'll be the most able to maintain profits in any economic state. So since it has such high levels of profit growth, it'll probably be able to withstand the effects of any recession. So it'll be able to maintain profits better than these other 2 companies. So now number 5, what company is worth paying the highest PE ratio for? I guess I can keep going. So it seems like based on what we've been talking about, Apple seems to be like the strongest company. So this may be the one that's worth paying the highest PE ratio for. But if you look at the values, it actually has the lowest PE ratio out of the 3. So this is kind of related to what we were talking about before with how PE ratio can indicate 2 things. So if you have a low PE ratio, that may indicate that you have low expected growth, but it can also indicate that the company is currently undervalued. So this is probably an instance of an undervaluation because based on what we talked about before, Apple seems to be a pretty strong investment, but it still has a low PE ratio. So this would probably be a case of being undervalued. And lastly, for number 6, if each of these companies drops suddenly tomorrow down to $100 billion in market value, which one would be a no-brainer that you would want to buy and hold? So what this one is basically getting at is based on the true value of these 3 companies, which one do you think is the best investment? And feel free to unmute if you did some research, but if not, I'll just keep going. Okay, so based on what I would think that Apple would be the best investment for me because we talked about how it's predicted to have the highest revenue 10 years from now, and it's also predicted to have the highest profits 10 years from now. So it seems like Apple would be a pretty good company to invest in if the market value suddenly dropped a lot. And yeah, I think that's it. Okay, so here's the quiz. So we can just get started. Okay, so if the price of a stock is $34.52 per share, and the net earnings are 35.5 million for 1 million outstanding shares, what is the PE ratio? So this question is a little bit more complicated than the ones on the handout, but we can still work through it. So they give us the price. We know that's $34.52, but we have to calculate the earnings per share. And that's based on the net earnings, and you divide by the total number of shares. So they give us 35.5 million for net earnings, and we're going to divide that by the 1 million outstanding shares. So as the name implies, it's earnings per share. So you just take the earnings divided by shares. So that's going to be 35.5. So to get the PE ratio, we're going to do 34.52 and divide by 35.5. And that gives us 0.97. So that's going to be our answer for this one. And yep, okay. So number 2, what is the formula for earnings per share? So does anyone, I think someone actually typed this in the chat, but we can see. Does anyone want to try to answer this? Okay, so I'll go through the different answer choices. Answer choice A says total earnings in a year by a company multiplied by the total shares in that company. So we just said that you want to divide, not multiply, so it's not going to be A. B says total earnings in 6 months by a company multiplied by the total shares in that company. So this answer choice is wrong in 2 ways, because you want to do it for 1 year, so not just 6 months, and you also want to divide. So answer choice B is also wrong. Next, it says the net income divided by the average outstanding shares. So this one is looking, I guess, better than the others. And now D says the net income multiplied by the average outstanding shares. So we don't want to do that one. So I think it's going to be answer choice C. Yep. Now, next question, we can keep going. So when comparing the PE ratio, it is important to, and now let's look through the answer choices. A says divide them by each other. So that wouldn't really make much sense because they're for different companies. So now answer choice B says put them in the context of their industries. So this is looking like a good choice. We can see the other ones. Multiply them by each other. This one also doesn't make much sense because you want to look at them separately. You don't really want to like make any do any math between them. And then the fourth one says buy the stock that has the lower PE ratio. So as we talked about before, you want to do something that's a little bit on the higher side, not too high because that might mean it's overvalued, but you want to do something that has a little bit of a higher PE ratio because that can indicate that the expected growth is higher. So answer choice D is also wrong. So for this one, it's going to be B. And the importance of putting a stock in the context of its industry is that different industries have different average PE ratios. So as I said before, tech stocks tend to have super high PE ratios. So it wouldn't make much sense to take a tech stock and compare that to something in, let's say, consumer staples. Like if you had a food company, that would probably have a pretty low PE ratio because it's not going to have as much growth over time. So if you take a tech stock, you want to compare that to other tech stocks so that you can make sure that you're getting the most, I guess, accurate comparison between 2 stocks. So mark answer. Yep. Now, number 4, which of the following is not a key statistic to look for when evaluating a company's worth? So we talked about PE ratio. That is important in looking at a company's worth. So we know this is correct. So it's asking for not. So choice A is going to be wrong. Earnings per share is an important thing to look at because, first of all, it can help you calculate the PE ratio. And it also shows you what the company's, like how many people are buying the company's products and what their income is. So this is an important statistic to look at when you're evaluating a company's worth. So B is also wrong. Now, the current stock price, you need both the price and the earnings per share to calculate the PE ratio. So all 3 of these answer choices are going to be key statistics. Now, lastly, the age of a company. It's not very important when looking at a company's worth. If you have an older company, like you might see companies that say like they were established in 1900 or something like that, that may, I guess that may attract consumers because it may say that this is like a product that's been tested over time. But when you're trying to evaluate a company's worth, you don't really look at the age of the company. So yep, now let's move on. So true or false, the true value of a business is likely to change and fluctuate considerably throughout the year. So I don't know if you guys remember, but we talked about the difference between true value and what the price of a stock is. So Well, the price of a stock, I don't know if you guys can see my cursor, but it would look something like that. Like it'll change a lot over time. But the true value of a business in the graph went something like that. So it's going to have a much smoother curve over time. So it's probably not going to change and fluctuate considerably. So this would be false. Yep. Now, I think that's it. So I'll stop sharing. Did I miss anything?
No, I think you covered it all, Nihal. Thank you so much. I feel like you have a really great understanding of how to calculate PE ratio, so I really appreciate you sharing it with us today. And I hope that everyone has learned a little bit of something from you today while they're doing their stock pitch reports. I know some of these things come up in your when you're planning on doing your stock pitch reports, and it's important to pick a stock that has all of these check boxes marked, and so that you can be confident in your decision for the stock that you pick for our stock pitch competition. So Nihal, thank you again. Great job today covering PE ratios. Does anyone have any questions? No, it looks like everyone's good. You got the clapping sign. All right, Nihal, well, thank you so much. Make sure that you guys tune in next week. We will have one of our regional advisory board members, Lance Cannon, going over ESG investing, which should be a really great discussion topic for all of us next week. So hope to see you guys there. Bye.
Thank you. Bye.
Thank you.